Hey everyone, welcome back to my channel, and in this video I'll be talking about an investment methodology called SIP and why you should go ahead and start one, especially in the kind of market scenario we're currently in. So SIP stands for Systematic Investment Plan and is mostly used in the context of mutual fund investments. Now when it comes to mutual fund investments, there are predominantly two ways to do that. Number one is lump sum and the number two is SIP. So a lump sum is when you make all the investment at once. So for example, if you have rupees 1 lakh with you and you make the entire investment at one go, that is known as a lump sum investment. And SIP on the other hand is when you make those investments at fixed intervals. So the interval could be daily, weekly, monthly or quarterly. Now I will get to as to which interval you should choose when you start with an SIP, but before that let me explain the reasons as to why you should choose an SIP over a lump sum investment. There is a concept in investment known as Rupee cost averaging, whose objective is to average out your cost of investment. So how does it work? Say you spend rupees 1000 every month to buy shares of company X and you keep doing so for a period of 10 months, and in these months the share price keeps fluctuating at different price points. So here we have the amount that is invested every month. Here we have the fluctuating share price, and this column shows the number of shares bought. So the last column is basically column B divided by column C. So after 10 months we ended up investing rupees 10,000 and the total number of shares that we have in our portfolio is 103. So in order to find out the average price per share, we have rupees 10,000 divided by the number of shares, that is 103, and we get an average share price of around 28.03. Now the above information is shown in a graph here. So you can see this blue line, this represents the share price every month, and since it's fluctuating you can see it's going up and down, and the orange line in between, this represents the average share price which we just calculated, which was 28.03, and as you can see it's constant. Now since you keep buying the shares at different market prices every month, at these market prices the average price for you is not too high, it's not too low, but it's an average, which is represented by this orange line here. So that's how the Rupee cost averaging works. So an SIP is a method which uses this concept of Rupee cost averaging. Say you started an SIP and you're making investments through SIP, so you're averaging out your cost of investments. Your cost of investment is an average. Now an only way you can get a better return out of this SIP is if your cost of investment is lower than this average cost, right? So if you can enter the market, or if you can start making investments at a level which is below this cost, then it would give you better returns. Typically you can do that when the market is down and when the market has fallen. So when the market was down last year due to COVID at around March or April, it was the perfect time to start making investments, because when the market would bounce back eventually like it did, you would get huge returns. People who made investments last year during that time eventually ended up getting returns of around 70 to 75%. But the problem is COVID was an exception, and such kind of event happens once or even rarely twice in a decade. Now in the normal circumstance the market does fall because the graph of the stock market is not fixed. It does not go up like this, it goes in waves. So it would fall, but the problem is it's difficult to know when that would happen. So it's difficult to time the market. For people who are into jobs or who have some other stuff in their life and who are not into investment and trading whole time, it's not possible for them to time the market and make an investment when the market has fallen, because you would have to keep observing the market the entire time. You would have to be aware about global and national news, what repercussions it might have on the economy or on the stock market. You would have to keep doing this, and still it becomes difficult to know when it would fall. And even if you see the market falling, it's difficult for you to know how long it will fall. So it messes your psychology as well. If it starts falling, you think, okay, it might fall even more, let me wait out and then I might enter. But then again, that does not happen. So it starts getting messy. So it's easier for you to start making an SIP. And that is the reason, instead of waiting for the market to fall and then entering, it's far easier to start an SIP and take the advantage of rupee cost averaging. Because like I showed earlier, rupee cost averaging uses the concept of investing in intervals, and an SIP does exactly that. Now, do not think much as to which option to go for, that is the daily, weekly, monthly or the quarterly, and just go with the most popular one, that is the monthly. It makes more sense to go with the daily or weekly if you're investing in something that is very volatile, that is it keeps changing its value very frequently. But for the sake of getting good returns, it does not matter much which option you choose. You can get pretty much the same amount of return if you keep doing this over a long period of time. So just go with the monthly option. And from the terms of financial planning also, it becomes more convenient because most people get their income on a monthly basis. And so if you're investing on a monthly basis as well, it's easier for you to keep track of your investments and plan your finances accordingly. So it's an easier and a convenient option to go with the monthly one. Now, one more reason as to why you should start with an SIP, especially in the market we are in now, is because the stock market is an all-time high now, and many are speculating that it might be in a bubble. So being in a bubble means that the market is overvalued, and after a point of time there might be a huge fall in the market. So in order to avoid the scenario of you making a lump sum investment now and then its value diminishing when the market falls, it's better to start with an SIP. So even if the stock market is in a bubble, but we do not know when it will fall, but even if it falls, since you are making an SIP, you would still be making investments in that fallen market as well, because you're doing it on a monthly basis, and that way you're averaging out your cost of investments. So that is also one more important reason as to why you should start with an SIP if you are deciding to start your investment journey now in the current market scenario we are in. So that was why you should choose to do an SIP instead of making a lump sum investment. If you have enjoyed this video, make sure you check the one where I talk about the why, where and how of investment. If you haven't subscribed yet, please consider doing so. Thank you so much for watching, and until the next video, see you, take care and bye bye.